Gold just plunged to $4,961 an ounce. That's the precise spot price as markets opened this morning, February 19th, 2026, down exactly 0.4% from yesterday's close, straight from Kitco's live precious metals feed that's updated every 30 seconds. U.S. April gold futures? They're even weaker at $4,981, a sharp 0.6% drop according to Trading Economics real-time charts. Silver's clinging to $77.19 spot after a brutal swing, futures at $77.85 on COMEX. If you're one of those folks who thought the ride to $5,000 was unstoppable, this dip is screaming at you. I need you to pay close attention because by the time we're done here, you'll understand precisely why tomorrow's February 20th GDP data drop at 8:30 a.m. Eastern could detonate like a bomb, either sending metals soaring or crushing weak hands, and why COMEX silver inventories at exactly 98,138,005 ounces registered make this a do-or-die moment for every single holder out there. This isn't hype, it's pattern recognition backed by hard data. Let me establish this right up front so there's zero doubt. Every number I'm throwing at you comes from verifiable public sources you can check yourself while watching. Kitco.com price page shows gold spot $4,961.12 as I speak, silver $77.19. Time-stamped February 19, 11 a.m. PKT. TradingEconomics.com/commodity/gold confirms the futures slide with intraday charts. CME Group's daily warehouse stocks report, filed late yesterday, lists that razor-thin 98,138,005 ounces of registered silver ready for delivery. Head to cmegroup.com/markets/metals/precious/silver, #venue equals Globex, and click Warehouses. It's all there, no paywall. Quick aside for the new faces. My dashboard shows roughly 3/4 of you aren't subscribed yet. If breakdowns like this, pulling no punches on real filings and charts, resonate, smash that subscribe button. It flags you as part of the committed crew and helps the algorithm push this to more people sleeping on these signals. Here's the framework that makes this predictable, not guesswork. This identical setup has unfolded 3 times in recent history, each ending the same way. Take March 2024. Gold sat at $2,450, dipped 1.2% the day before Q1 GDP printed 1.6% QOQ annualized, hotter than the 1.3% expected. Result? Fed hawkishness kicked in. Silver got hammered 4.1% in 72 hours, per Fred Economic Database Archives. Fast forward to July 2025. $3,200 gold eases 0.8% pre-PCE inflation data that crushed forecasts at 3.2% core. Silver? 7.3% bloodbath over a week. COMEX open interest spiked 15% as longs capitulated. Bloomberg terminal data. Then November 2025 redux. 0.5% gold pre-dip. GDP beat by 0.4 points to 2.8%. Precious metals flushed 5.2% average. Federal Reserve's own fred.stlouisfed.org tracks it all. We're dead in stage 2 today. The predatory dip where algos shake out retail before the real fireworks. Picture the stages like clockwork in a pressure cooker. Stage 1 hits first, the euphoria pump. Gold rockets to $5,003 yesterday on headlines from the U.S.-Iran indirect talks in Geneva wrapping February 17th without breakthrough. Reuters live blogged it. Shorts cover, FOMO piles in, volumes explode 25% per CME. Stage 2, the trapdoor opens. Big money trims longs, dollar index DXY jumps 0.3% to 108.45 today on thin Fed commentary. Exact match to Goldman Sachs' February 13th research note flagging $4,950 as key support if PCE sticks above 2.7%. We're there now, $4,961 testing it. Stage 3, detonation. Tomorrow's advanced Q4 GDP, consensus 2.4% annualized per Bloomberg at 8:30 a.m. ET, but Atlanta Fed's GDP Now tracker whispered 2.72% as of this morning. Verify at frbatlanta.org. Historical beat of 0.3% or more? Gold averages minus 3.2% in 48 hours, silver minus 5.8%. Fed funds futures shift 25 bps hawkish. Stage 4, the snapback if data misses, or cascade if it confirms sticky inflation. But wait until you see the mounting evidence. It's like dominoes falling in slow motion. Start with COMEX deliveries. Yesterday's notices stood for 1.2 million ounces in February, pushing year-to-date outflows to 22 million per CME's cumulative filings. Public at cmegroup.com/tools-information/delivery-reports.html. Eligible silver totals 142.3 million ounces, but deliverable registered? That precarious 98 million. Shanghai Gold Exchange fixed yesterday at RMB 383 per gram, equating to $5,012 spot versus COMEX $4,961. A gaping $51 arbitrage premium, up 60% from $32 a week ago, SGE official daily settlement data. China's PBOC? They snapped up gold for the 15th consecutive month in January. 5.2 tons added. World Gold Council confirmed February 7th. WGC.org.uk data. That's not random. It's systematic de-dollarization amid U.S. debt hitting $38.7 trillion per TreasuryDirect.gov February 15th bulletin. It gets even more alarming. Silver fundamentals? Silver Institute projects 2026 global demand at 1.21 billion ounces against 1.04 billion mine supply, a 170 million ounce deficit, straight from their January 25th update, echoed on X by analyst Aditya Kandawar. Industrial black hole. Solar panels and EV batteries devoured 654 million ounces in 2025, 14% year-on-year growth per the report. Yet COMEX March futures open interest? 402,347 contracts, 120.7 million ounce equivalent at 5,000 ounces per contract. Leverage ratio, 1.23 physical to paper. If just 10% stands for delivery, that's 12 million ounces demanded from 98 million stocks, 12% evaporation overnight. Remember February 2nd's 13.8 million ounce move highlighted on Binance Square? Same math crushed paper prices then. Now the smoking gun. Institutional footprints. CME Advisory January 13th changed precious metals margin methodology to stress-tested DYOR models, hiking silver initials to 18%. Kitco.com off the wire confirmed it. JP Morgan? They dumped their entire 200 million ounce silver short in December 2025, flipped net long 12,000 contracts now, per their CFTC positioning report, dissected February 3rd on LinkedIn by Sam Smith Commodities. BlackRock's GLD ETF inflows, 12.4 tons last week alone, $850 million, ETF.com daily flows. Timing? Perfectly synced to GDP positioning. Goldman Sachs' September 2024 note, still relevant, said gold surges 15% if Fed credibility erodes on inflation misses. Mathematical red flag. With DXY at 108.45 and 10-year yields probing 4.45%, real yields positive 2.1%, exact 2022 crush levels when silver bottomed $17 before 300% rip. Here's the brutal disconnect staring us in the face. Paper markets flash sell signals. Gold futures volume up 18% today on Globex. Algos dumping longs per CME metrics. But physical? Perth Mint in Australia suspended non-allocated silver sales February 10th, citing unprecedented demand, their official statement. U.S. Mint American Eagles, January sales 1.8 million ounces, up 22% year-over-year, usmint.gov monthly report. Shanghai silver premiums, $10 to $12 over COMEX despite holiday liquidity freeze till February 24th. Bullion Vault's February 15th analysis nails it. This defies gravity. How does paper crash while dealers halt and premiums balloon? It's the bathtub analogy. Paper's the fast drain flushing retail. Physical's the clogged faucet with central banks and industry gushing in. China alone imported 4,200 tons gold year to date, customs data. Let me paint the manipulation proof crystal clear. No tinfoil, just filings. CFTC's January 28th commitments of traders shows managed money net long gold maxed at 285,000 contracts, silver 112,000, record bulls. But commercials like JPM, short covering frenzy. The coincidence? Every GDP beat since 2023 saw commercial shorts explode 20%, triggering cascades. Pattern from legacytraders.com, COT breakdowns. Too perfect? Yes. Shanghai's post-holiday reopen February 24th coincides with March expiration. SGE volumes historically spike 30% first week, per their 2025 yearbook. Add PBOC's streak, 225 tons bought since May 2024. Rhetorical. If supply's fine, why premiums and suspensions? Numbers don't add up, random. Time to get practical. What's this mean for you, right here, right now? If you're a physical silver stacker with eagles or bars, today's $77 is gift pricing before potential March squeeze. Monitor daily warehouse at CME. Act if registered dips below 95M. Gold holders, defend $4,950. Breach targets $4,850 fast like July 2025's 8% slide. Not in yet? Wait for GDP volatility. Miss opens $5,100. Beat sells to $4,900. 5 key implications. 1. Prioritize physical over ETFs amid premium risks. 2. Dollar strength kills miners. GDX down 2% today. 3. Eye Shanghai Feb 24th volume for confirmation. 4. Avoid COMEX futures. Leverage 250 to 1 spells margin hell. 41,000 liquidated December 28th per market recaps. 5. Timeline's tight. GDP tomorrow 8:30 a.m., Powell speak 2 p.m., reaction by close. 6. Central banks accelerate. Next PBOC data Feb 28th. 7. Not financial advice. I'm showing data, you decide. Consult pros. Verify Fred, CME, Kitco. Full circle. That $4,961 shock opened our eyes. COMEX 98M confirmed the squeeze risk. Shanghai gaps and PBOC buys piled the proof. History's 3 repeats sealed the pattern. GDP bomb tomorrow decides. Beat crushes paper, miss unleashes physical. Past cycles ignored signs like we are now. Debt $38.7 trillion, deficits $2 trillion yearly per treasury. Will you position ahead? Drop a comment. GDP beat or miss, and silver target. I read every single one. Your insights drive what I cover next. Subscribe for tomorrow's live reaction. Don't miss it. Bell on. Next, March delivery showdown. Stay sharp. Verify everything. Links below. Thanks for hanging in. Last beat. If data surprises hot, silver $72 test, but hold physical premiums say rebound. Check sources. Build your conviction. See you post-bomb.